Hello, I'm James Baxter. I'm the founder of Tideway, and I'm going to talk to you now about Tideway's dual account drawdown service. And hopefully I'm going to explain why we think that one day all drawdown accounts will be built this way. So firstly, we're going to have a quick look at all the products that are available. They broadly fall into three categories. We have insurance companies that offer insured pension contracts like Aviva, St James's Place, Scottish Widows. We've got fund solutions that are targeted towards DIY investors on platforms like Hargreaves Lansdown and AJ Bell. Funds like the funds issued by Vanguard, they're lifestyle funds, which are targeted at drawdown investors. And then the wealth managers obviously are getting involved. So we've got Rathbones, Brewin Courters, Evelyn Partners, Tideway. And the common solution for those will be some sort of balanced portfolio, often in the form of a model portfolio, which enables the wealth managers to manage multiple clients all in relatively quickly and easily. Now, all of these products will end up with some sort of mix broadly of bonds and equities, higher returning volatile equities and bonds, which in the long term generally earn less than equities, but often are more smooth in their returns. And the problem comes with a lot of the products that are available is how those investments are accessed in order to fund the monthly withdrawal that drawdown investors take. And if the product basically sells across each of the investment classes, so for example, if you've got a 60-40 mix of bonds and equities, for each monthly withdrawal, it sells 60% of equities and 40% of bonds. This is when you'll be exposed to drawdown's biggest risk. And whilst it definitely happens in a fund like Vanguard's, it's probably going to happen with an insurance policy. And again, with these wealth managers who are offering model portfolios, if they rebalance the portfolios after a withdrawal, then the chances are that you'll have ended up selling equities as well as bonds in order to fund the withdrawal. So what is drawdown's biggest risk? Well, it's because if you're investing in equities and selling equities to fund income payments, you're going to become a forced seller of equities in a downturn. So just to see the impact of this, we've looked here at an example investor investing in a typical stock market, which has got corrections along the way. Generally, we have a 20% plus correction every 4 or 5 years in equities on average. But long-term investors can ride those out. And in this case, somebody investing £500,000 ends up with a return nearly over 3 million, and they make a 8% per annum compound return over 25 years, which is fantastic. If we look at the same investor investing in the exact same investment market, but drawing an income, starting with 500,000 again, but drawing an income, in this case, we did £25,000 a year, increasing by 3% a year with inflation, then the return that that investor makes is a lot lower than the lump sum investor. Exactly the same market, exactly the same risks. But because that drawdown investor is selling units every month, as the market turns down, they start selling investments at lower and lower prices, which means they have to sell more and more units every month to meet the withdrawals. And that does irreparable damage to the account value. In this case, the return 3.9% compared to 8%. So it's less than half the return that you'd expect. And you're taking exactly the same level of risk. So how do we get around that? Well, the way we get around that is actually relatively simple. We have two accounts. So we have two separate investment accounts with two separate model portfolios in them. The longer term number 2 account has got your mix of equities and bonds for the long term. You may be happy just to have equities, or you may want some bonds in there to de-risk it a little bit, but basically those investments can stay in there for the long term. We take the income and profits from that account into the short-term account, and we set aside an amount at outset in the short-term account so that that number 1 account can fund the withdrawals on each and every month. And the number 1 account has very short-dated investments in it, so they're not volatile. And it's important, it's not just about having bonds, it's about having short-dated bonds that aren't going to be affected by interest rate changes, and we don't have any equities in there that will be affected in a market downturn. So that account should be offering a nice stable return from which the monthly withdrawals can be funded. But the point here is that we have the opportunity to suspend profit taking, if you like, from the number 2 account into the number 1 account. If the market turns down, we can wait for a recovery in prices before we re-top up the number 1 account. So we might have, let's say 5 years worth of income in the number 1 account, and that gives us 5 years to recover investment values in the number 2 account if there is a downturn. So if we look at the impact of that, and we go back to our example, the same hypothetical stock market, the same £500,000 investment, and £25,000 a year escalating at 3%, then the impact is pretty amazing. So we get a 66% uplift in the return offered by the dual account. And bear in mind, we're actually taking less risk, because in this case, we set aside 25% of the fund into the lower risk number 1 account. So we had actually at outset had less risk overall than somebody who just invested in the long-term investments. But the return improvement is substantial, and we get 66% return improvement, which in this case means ending up with, the starting capital of £500,000 that you started off with is still in your account after 25 years, versus almost fully exhausting the account over the same 25 years. So it's a big improvement. Now, why do we think it's important to be thinking about this now and looking at a dual account solution right now? Well, here's the S&P 500 index, which is the sort of driver behind most equity markets in the world. And we can see that it's pushing up to a new all-time high. We've recovered from the last drawdown, the 21-22 drawdown, and we're substantially above the heights reached there. And we're a good period on from the last major bear market, which was after the financial crisis in 2008, which took several years to recover from. So it's fair to say that in the next 4 or 5 years, there's a very good chance we will get a downturn in markets. And so you want to be prepared to have some money set aside to fund your income withdrawals through any market downturn. So if you like what we've heard, then please contact us on the email address here. Also, you can visit our website where we have some pages on the dual account drawdown. We have a calculator that helps you think about how much you would put in the number 1 account versus the number 2 account. And there's a little questionnaire that you can take about your current drawdown solution, which will tell you whether or not you're exposed to this risk of being a forced seller in a market downturn. Thank you very much.